Well, survival will be a big theme of our conversation.
Yes, it will.
I mean, you've been an immensely successful investor for 50 years now. And so a big part of what I wanted to talk about is actually how you survive over all of the years. So to wind forward a little bit, you ended up doing your undergraduate degree at Dartmouth and then graduated from the Tuck School of Business at Dartmouth. And then you left, I think, in 1969, and it was the middle of the Vietnam War. So you joined the Navy and ended up serving from 1969 to 73. I remember you saying to me once that you were an incredibly effective naval officer and you were cleared for command at sea at 22, I think, which I think means you were one of the youngest people in U.S. naval history to be actually cleared for command, to be given clearance to be in charge of these big ships. Can you talk about that experience of being in the Vietnam War for 4 years and what you learned by having so much responsibility thrust on you at such a young age?
You know, it's a funny sort of starting point to that is that, so I was going to school in New England, right? And I was in NROTC. And so for some reason, and I cannot explain why, I had my heart set on being on a destroyer in Pearl Harbor, Hawaii. I mean, I bought a chart of the Hawaiian Islands. I circled Pearl Harbor in red, but it was really stupid because what I didn't understand was that was the front line for sending ships to Vietnam. So anyway, so my reward for that was I had 3 deployments. I was only in for 4 years, so I had 3 7-month deployments to Vietnam. So I was, home for 6, gone for 7, home for 6. I mean, you can run the math. So I got 3 tours in. So I had a tremendous amount of sea time. I recall coming out of, there was a big anti-war movement in the colleges. I remember starting, and for the first year in the service, I wasn't committed at all. I just remember that vividly. It was kind of half in. And then I somewhere along the line said, well, you got 3 more years, put the afterburners on. And then I got really serious about it. And then I started really becoming effective. So what I remember about was, first of all, the idea where you go in as a kid, come out as a man. I came out as a very, very serious man. We fired big guns that fired bullets a long way. I had all kinds of intensive middle management. My last job, I reported directly to the captain. I had 65 people working for me. I've never worked that hard since, ever. It was grueling duty when you're, in a war zone. You're standing 8 hours watch a day plus your regular job. So the other memory is I got out, looked for a job, and I didn't get a single question about my Navy career, which is kind of interesting because that's all I knew, But there were a lot of clues in there about my self-concept, my effectiveness. Play the tape way forward. And I have this idea, unverified, but we learn stuff in our lifetime and you put it in the closet and 20 years later it comes out and you have this stuff that's there. Knowledge is rarely wasted. It resides there. My management skills as a money manager are way above most money managers who tend to be loners and I got lucky because I had that middle management experience at an early age. And a lot of the functional parts of it, I use today in structuring the firm. So it was just like an amazing proving ground. The other part was I got these high ratings, and yes, I was clear command really early. I never wanted to stay in. I'd go see the captain. He'd say, you're doing a great job for me. What are you going to do when you get out? I was going to manage money. I was the unofficial financial officer to the investment officer of the ship. I remember looking at mutual funds and reviewing it for people. And, I was already thinking about investing.
And you were getting the Wall Street Journal delivered to you on the ship, right? In batches
In batches. Well, it was third rate postage. So you'd get, 13 in one dump, I mean, we'd get mail delivered by helicopter typically, they'd come and drop a big bag of stuff. Yeah, it was, it's hard to read when you get 13 in a row, because you're losing the pacing of it. But I was still very interested in investing even through the whole time in the Navy.
The other thing that seems extremely relevant about your career in the Navy is that you started, I think, in June 1969, right after this disaster that I wrote about in my book when I was writing about you in the chapter about Charlie Munger as well. The USS Evans had this catastrophe, which I think made you ultra sensitive to risk and the dangers of human error. Can you talk about what happened to the USS Evans, and which was another destroyer? So you were on a 437-foot destroyer, as I remember.
Right. About the same size, yeah.
Yeah, and as a young lieutenant, you would be in charge at night and have 240 people's lives basically in your hands when the captain was asleep because you became the de facto captain. And you've basically just seen this disaster with the USS Evans. So if you could give us a little bit of color on what happened and the impact that it had on you, that would be great.
I can draw that into, which reminds me of sort of a book I read years ago by a wonderful author named Jim Ware about the psychology of money. It's worth reading. It's quite good. But I didn't realize at the time, but I was already very tuned to risk. Okay. There's pluses and minuses to that, by the way. Okay. So I grew up in a very active family of 6 boys, right? Well, if I saw something was risky and exceeded my risk tolerance, a daredevil can block that out and overpower it. I could never block it out enough. So we went to Chicago one time to an amusement park. The owner was a friend of my dad's, and he would put us on the rides, and the fastest roller coaster was there. And I'm the only one that didn't ride it. Okay. And of course, you get called chicken, and my brothers are making fun of me. I eventually rode it later in the day, only after they tested it, and I was satisfied that it was going to be okay. I've done that snow skiing. I've done a lot of snow skiing. Typically, I go to an area, I'll scout all the runs, ski them the next day. That's just, or if I'm in a pack of people and they're doing runs that I don't necessarily want to do the runs, I'll just split off and ski myself. What is the book, Psychology of Money? And Jim Ware's a great thinker, by the way, talked about right-left brain balance. That is the ability to assess risk and opportunity simultaneously. And as you grow, and he claims Buffett has that, can look at both sides of it. And I think I probably have that. It's a gift that you're born with. And I can never look at something and shut out the risk part of it totally. I can never do that. I can't. Okay. It's always there. And I can't shut it out. Well, that's good in a way. I could still go after the return, go after the opportunity, but I can never shut it out. So the Evans just crystallized in my mind, and so I'm starting to think, how do we avoid that? And one of the simple
just so that people know what happened, basically at 3 a.m. one night, the captain's asleep and a couple of these lieutenants who are young, very untrained guys are in charge, and they turn the wrong way, and the ship is cut in two, and 74 people died, and they were court-martialed. And I remember you saying to me, Fred, you had kind of seared into your mind the image of the ship. What did it look like?
It looked like you took a welder and he cut off the front half of the ship. I mean, it literally looked like the ship just stopped, just almost where the bridge was. The front half was gone. It literally was right straight up and down. It's seared in my mind. So what you do is you start thinking, okay, I'll give you an example. When you're on a bridge, the radios are blaring. You got 6 or 7 people on there. You've got the radio, the engine room calling you on something. You got all these distractions. You have to cut through all that. So I always had the habit of walking out of the bridge wing. If we're turning right, I'd walk out of the starboard wing and I'd take a peek to see what's out there. If we're going left, before we threw the helm over, I'd go out and take a peek. That was 15 seconds. But I want to make sure there was nothing out there.
So it's really like a simple rule, like very similar to saying when you're going to change lane in your car, that you're just going to look because you can't really trust your mirrors in case there's something in your blind spot.
Yeah, you got it.
And you said to me also once that basically the Navy was obsessed with the idea of process, of following process, honoring process. How did that twin obsession with safety and survival and honoring process affect the way that you've approached everything to do with risk in your life?
I have to confess to you that many decisions I made over my lifetimes were implicit decisions, not explicit. I didn't sit around and say, you got to think about processes, but I walked out of it seeing safety in the Navy was paramount. If you read the history of World War II, one of the reasons that we won is the Japanese thought their pilots were expendable and we would do everything we could to save a pilot. It turns out they're really expensive to train and you only have a certain pool. And so the Navy was obsessed with safety, which I thought was great. The process part had to do with this. You're on a bridge. So you've got multiple people. You've got a guy behind the wheel driving, and he takes orders from the conning officer. You always want to make sure everybody knows who the conning officer is, okay? If the captain's on the bridge, anytime he wants, he can say, this is the captain, I have the con. That means the only person that can tell that guy what to do is the captain. The XO could also do the same thing, the executive officer. So just think about that kind of clarity of thinking, that clarity of process. So, to carry it forward to managing money within my company, we have every stock, there's one person responsible for following the stock, and it's assigned. Everybody knows who it is. Every client we have, there's one portfolio manager that's responsible for shepherding that relationship. We don't move it around much. There's also one portfolio assistant that's responsible for, developing the relationship. So you see that kind of line clarity throughout. Okay. So I think that's sort of management 101. The idea of process, though, came more slowly. I wish I could give you a moment when I realized that it was the right thing to do. It might have been when I started DGI, because I was part of a star system. I think a group effort can be superior to one. If you have a group effort, you have to have a process. So that might have been the trigger on that. But I don't know whether the Navy itself was so, fired up on process. It was very fired up on clarity of communications, clarity of mission, and all those kind of things.
We'll come back to this issue of process and how you laid out your process when you started Disciplined Growth Investors, because I think it's a central aspect of your success. But to go back to you leaving the Navy, and as you said, you came out deadly serious. You came out in 1973, and you started your investment career as an analyst, having not had much luck with your interviews. You started as an analyst for the trust department of the Northwestern National Bank Trust, which is, I think, a Minneapolis bank that was later acquired by Wells Fargo. And you said to me before that it was one of the greatest gifts that you started your career in 1974. So you got to see the crazy euphoria of the early 70s, and then everything totally going to hell in 1974. Can you talk about that, about what a formative experience it was to go through the boom and bust of 73 and 74?
Let me preface that just a little bit by saying that because my dad was a stockbroker and I was a saver and I got fascinated with the markets. I think I bought my first stock when I was 10 or 11. Okay. So I had spent 15 years trying to figure this out without really, I was reading books, I was very interested at Tuck School, but Tuck School didn't really focus on investment management or analyzing companies. So, maybe the table was set. So I started Northwestern Bank. I'm a young guy and I open to learning, and it looked like price earnings ratios were pretty high. So I go to director of research, and I said, Stu, it looks to me like the market's pretty expensive. And he patted me on the shoulder and said, don't worry about it, young man, you'll learn soon enough. And then I had this weird mind for data points, and I watched the Xerox. Our analyst next to me was following Xerox, and it was a $140 stock, and it was going to make $2.35. I remember that. So that was about 60 times earnings. And they would lease copiers on a 3-year lease, double declining balance depreciation. So the sales were slowing, but earnings were still going up because depreciation was running off. And the stock, I think, went from 140 to something like 9. And then there was a mortgage insurance company called MGIC, and the star analyst was covering it, not me. And it was 100, going to make $2. So it's 50 times earnings. It dropped to 50, and he pulled the string, and all the PMs jumped in, and the bottom did 6. So I'm watching this, okay? And then from that point on, I started making a lot of money in stocks. I never stopped. And I think I saw the dichotomy between the company real value and the price of the stock. And it was compressed in a 2-year time frame from the end of 73 to the bottom of the market in 74. And
I remember you also telling me an extraordinary story where you had been following, I think it was Corning Glass, and you went to your boss, who I remember you saying was an incredibly smart guy and a really good investor. And you said, look, I don't really see any earnings here. I don't see any value. And he said, don't worry about it. It's a faith stock.
Well, he was the head of the trust department. He was a brilliant guy. I loved him. He was a fabulous guy. He said, don't worry about it. It's a faith stock. all of their earnings were from their unconsolidated subs, and it was an expensive multiple. It was like, so, I just watched, but I thought, wow, okay. It was a learning.
So Fred, when you saw a period like that, having lived through it viscerally and seen the nuttiness of it, how did that prepare you for the experience of, say, 99, 2000, or then 2007, or then the period with the FANGs before COVID? Because you wrote something in March 2020, for example, where you said, this is in one of your insights on your website. It says, 40 years after the Nifty 50 and 20 years after the rise and fall of Cisco, the stock market is once again in the grip of the great company, lousy stock syndrome. The list of extremely overpriced stocks includes many small companies, but also includes the 5 largest companies in the US by market cap: Microsoft, Apple, Google, Amazon, and Facebook. And you were predicting at that time, if you compute the likely return for these 5 stocks that were about 20% of the S&P's entire value, you were expecting them to make about minus 3% a year at exactly the time when everyone was very bullish. So can you talk about how that early experience in a way prepared you for later periods of euphoria when people would become obsessed with great companies without realizing that a great company can be a lousy investment?
Really 3 times in my lifetime where you just had, really extreme overvaluation. And so that's not a large statistical sample to learn from. So I would tell you that I think quantitatively, I learned a lot from it. I'll explain that in a minute. Emotionally, I don't know. It's miserable, okay? Because the backside is always really miserable, like we're going through right now. What it prepared me for, it did something, and I mentioned we're working on a magnum opus on risk, because I think Graham always said, manage the risk and the return will take care of itself, okay? And not all risks are the same. So, I mentioned that to you in the email I sent you. Overvaluation is a risk you can't diversify. If you have 25 stock portfolio that's overvalued, all the stocks, or 50 stocks, you're going to lose money. I don't care. Eventually, they're going to sell back to what they should sell for. So you can't diversify that away. It's also easy to quantify. It is actually easy to quantify. You can tell when something's like way overpriced. It's just really hard to deal with it for a variety of reasons. I didn't have this happen in 73 because I wasn't a portfolio manager, but I just observed and I took advantage of the backside of it by finding stocks that were really cheap and making a lot of money with them. So that was okay. 99, 2000 was the worst period of my career for a variety of reasons. I just started DGI in 97. I was getting fired all over the place. There was a money manager in Akron, Ohio named Oschlager, Oak Associates, which was the Kathy Woods of this cycle, okay? And I had a whole bunch of clients in Akron, and they were firing me and reinvesting in this guy. And, of course, he took them down 80 or 90%. I had beautiful portfolios for him.
Yeah, and he had an enormous bet on Cisco, for example. So
he did.
He owned these incredible companies that were like the FANGs, or they were like the Nifty 50. They were great businesses. But I remember you saying to me, he just immolated his shareholders because they, would have been fine maybe for them to have 10% of their portfolio in a racy thing, but they were giving him all that money.
He said, I want all your money, which I thought that's just my opinion, but there's a hubris there that's pretty extreme. So that was kind of the first time I saw actually managing a business and managing portfolios, the blowback. I had clients sticking stocks in their portfolios. 2 or 3 clients didn't fire me, but they stayed mad at me for at least a decade or longer. One guy fired me. His wife stayed with me, and now he's a fan again 20 years later, okay? And another guy was just mad at me. Part of it was they were embarrassed that they stuck stocks in there. They got killed, because stocks they stuck. I would let people put 1 or 2 in. That was about it. But it was miserable. I hated it.
And just to clarify, this is because most of your business is managing separate accounts, and typical separate account with you. At the starting point, I think the minimum is 15 million. I remember you once saying that the average account is 30 million. So these are people who are supposedly pretty sophisticated on the whole, but they were still getting caught up in the euphoria. And we're looking at you making 12, 13, 14%. And we're like, what the hell are you doing?
I was actually just to go way back, because we've had customers for a long time, a lot of the people that were rested, we started with a funny story. I think they started with a couple, 200,000 or 300,000. They have 45 million now. Okay. They fired me in 99. So they started with 200,000. They probably had 10 million at the time or something like that. They fired me, and they're wonderful people. And I called them up. I said, I'm tearing this letter up. I don't accept this. We have too good a working relationship. You can't fire me. And they said, we'll talk about it. They talked about it overnight, and they said, we changed our mind. We're staying with you. And they're still customers. So it wasn't that I had at that time, we raised our minimums after we had more money to run, but we used to have $1 million minimum. And so I had one of the things that's been meant the most to me is I've taken a lot of people that were hardworking people and made them a ton of money. And so that was the people that were turning, I went down to see some doctors in Northern Iowa, and I lost my temper, which I rarely do at a client. And they were criticizing me, telling me, like you're saying, at the time we were doing 17%, but everybody knew 25% a year was in the bag. And they started criticizing me, and they said, you don't really know how to buy growth stocks. And I lost my temper. And I said, look, I have a thick skin. I can take a lot of heat, but you at least have to be accurate in how you're criticizing me, because you don't know what you're talking about. The lead doctor in the group, watch this, 3 years later, followed me out after I came down 3 years later, out to the car, and thanked me and said, you saved us, and I can't thank you enough. And so they didn't fire us, but I was just taking a beating. So this time, and I'm going to put 07 aside for a second, because that was, I think the basis of 07 was the craziness in the financial system. I think the financial system, it wasn't so much overvaluation. It's just that the system was this close to collapsing. The one that sticks in my mind is 20 and 21. And I have to say, I think we did the best job I've ever done in the face of that. Okay. Because the reality is that, we go into this and we have some stocks that are too expensive, and they have huge unrealized gains, and we have a lot of taxable clients. So what do? And we sold outright a bunch of them and trimmed a lot of them and de-risked the valuation of the portfolio. So we enter this year with good investment value above our hurdle rate, if you will. Okay. And the down market just elevated our return, but we don't have an overpriced portfolio now, so we're not worried about that. There's still overpriced stocks around, and they'll eventually sell at whatever value they should sell at. So I think we did better this time, but it's still miserable. I'm watching the markets, and we're down. We're not down. We're down, I think, 18 or 19% from the peak of November of last year. It's not too bad. But I'm looking at the carnage everywhere. I don't know if you're seeing Tesla today. It's getting just destroyed in the market. So we don't have the waterfall declines that others are experiencing. We've had a couple of bad stocks, but you always do. But it's still miserable. I hate it.